Welcome to the weekly update where I'll go over the action in the market for the week of February 18th through the 21st, and we'll see how things look for the week of February 24th through the 28th. Okay, we were holding up there pretty good until Friday. We had a pretty significant down day. That's the negative side. We've switched over to negative in the short term. We dropped below the 20-period moving average on the daily charts, and we're seeing some weakness there. But for right now, the 50-period moving average is holding. So we're still positive in the intermediate term and the long term. We're still positive here on the weekly side as well, but we're seeing some weakness, some things we want to keep an eye on to see, is this just a pullback before we get set to go up? Or is something more negative developing? We're seeing a bit of a breakdown between growth versus value. We want growth to be outperforming value, and it has been until this past week. And we want discretionary to be outperforming staples, and it was until this week. And when we start to see shifts like this is when we get a little bit more defensive. And we don't know what's going to develop. Lots of people try to claim that they know what's going to happen. That's just a fool's errand, as far as I'm concerned. We can only evaluate and come to a conclusion based on what we see right now. And then that's why I do the videos every day, is to update these things. And I know the videos are long and they're boring and people are busy, but if you really want to keep up with what's going on, checking in to the daily videos might really be to your benefit. Okay, some notes before we get started. Please, as I just said, I do videos every day. Excuse me, and I always do these videos take one. I just hit the button and start talking, so you're going to hear me fumble over my words and clear my throat and so forth. But I do videos every day. I provide commentary and analysis that you may find helpful to you. Also, a few weeks ago, maybe a month or two ago now, I started putting out a daily newsletter, and then every week I do a weekly newsletter. Amazing how that works. Right now it's free. If you want that, please leave me a comment. I have an email address that I provide here. I'm actually still thinking of maybe shutting down the comments because I just get garbage comments both on YouTube and on Rumble. And anybody who really wants to communicate with me, I give an email address. And if they're going to take the extra time to do that, then I'm willing to talk or at least read their email. I still get a few junk emails that way anyway, but feel free to check out this newsletter. And if you have any feedback, it's free. Eventually it'll be $8 a month, but if you have any ideas, if I'm including too much, too little, you want less charts, you want more charts, I'm an educator, and a lot of what I've incorporated over the years has come from feedback that people I'm trying to educate. And so if you have any ideas, please let me know. Now, there is a bit of a limit on this. In the program that I have, that I'll talk about here in just a moment again, I actually go through and say, okay, here's some ideas for positions that you may consider. And the folks that are in the program, that's part of their daily and, well, not their weekly, but their daily newsletter, where the version that will be $8 a month, that won't include that, because I don't want people coming in who don't really understand what's going on. They think that they can just follow what I say like a religion and just go for it without really understanding what they're doing. And I don't want to go down that road. I'm an educator, not a guru. So that part won't be included in the newsletter itself. Now, the program that I do have, and I'll talk about down here, here's a link. It's at Substack, and here's the link to get you there. It's also in the description. It's free for right now. Now, at some point, and I've been threatening this for months now, I have some logistical things that I'm still trying to work out before I can really lock that down. There'll be a very liberal trial period. It will be $97 a month for the full-blown program. And then if you want the newsletter all by itself, that's $8 a month. If you want the videos in real time, meaning as soon as they are available, that'll be $20 a month, and that'll be handled by YouTube and Rumble that way. So there's some, it's kind of a la carte. You can just pick out those things that you might like. Well, I also have a PDF below every video that I post And there are folks who find that valuable to download and look at that. It includes the slides, it includes the charts that I go through. Also, there are pivot points that I update every day on the community tab on YouTube. I can't do this on Rumble. I can only do it on YouTube. And the pivot points, there are some that last for the whole month, but I update the chart every day with that particular bar for that day. There are other pivot points that only apply to that particular day, and you'd be surprised at how accurate those are. And so it might be to your benefit to check those out and see if you would find them useful as well. I do have a private Facebook group, not many members, not much activity. I tried posting the newsletter there for a while, but nobody really seemed interested in it, so I stopped doing that. If you want to change that, let me know, join the group. If you want to have more communication with me, join the group, and we can have some back and forth that way. And like I said, with YouTube and Rumble comments, I'm not a real confrontational educator. A real educator should just present information and then let you reach your own conclusions. And that's what I try to do. That means I'm not controversial. I'm not saying, the market's going up, baby. The market's going down. We're going to tank 45%. I don't do those kinds of things. I just evaluate where we're at right now. And then I really promote critical thinking, where you take what I'm presenting here. Maybe you reach a slightly different conclusion. Maybe you reach the same conclusion of how I'm interpreting the charts. And then you come up with your own decision. And so now you're developing a skill. Well, because I do things that way, I don't get a lot of comments. And the comments that I do get are usually garbage comments. Sorry, and I'm apologizing to anybody who does leave a legitimate comment, and I treat that with respect. But most people that want to talk to me, they email me. They don't really care if other people see their comment or not. And so I'm thinking of locking those down just to save everybody some trouble. Okay, and then I do post on YouTube and Rumble. All right, so going back over the week, we were down 1.66% on above average volume, and we were drifting a little bit. We weren't that far above the moving average, but we had options expiration on Friday, which is kind of its own beast, and that might have explained the downward move. What we're going to need to see is what's going to happen next week. Did we fall enough for some of the smart money, the people that really control the direction of the market, not hedge funds, not mutual funds, but the real institutions, the big trading conglomerates, the ones that have billions and billions of dollars? I sound like Carl Sagan here, and really can decide whether the market's going to go up or down. I try to track what those folks are doing and then just do the same thing, because they are so big and they have such an impact that we can see what they're doing. And that's what I try to do in our program here. Okay, so we are still positive though in the long term. We're looking a little more negative in the short term on the daily side. We're right at support in the intermediate term. We're also positive on the daily charts in the long term. And we're pretty much positive here as well. And there's some inflation concerns that are coming back into the market. We're seeing the CRB index, which are commodities. Those are going up. And now interest rates are actually coming down a little bit. They're a little bit more friendly. They declined on Friday. We're under that 4.5% level. And that could have helped stocks fall even further, or prevent stocks from falling even further than they did. But if interest rates start to go back up because of inflationary concerns, that could be negative for the market. And we're also in a negative seasonal time. The second half of February in a post-election year, which is what we're in right now, tends to be kind of challenging. Doesn't mean we're going to go down. It just means historically we have gone down for the second half of February. And then geopolitical concerns, you've got Trump out there doing all these executive orders. You've got Doge, you've got things between Russia and the US and Ukraine, and things going on in the Middle East and Israel. Any one of those things can explode and come to the forefront at any given time. And then this past week, we did get the meeting minutes from the FOMC, but there were really no surprises, nothing that we hadn't already heard before. And we're still not trending. And we're seeing that in the short and intermediate term on the daily side. We're seeing it here on the weekly side as well. We're still positive here on the weekly side with the green line above the red line, but both lines are coming down, and I will show you that chart. Okay, so the markets were closed on Monday for President's Day. You probably already know about that by now, since that day was in the past week. We did set new all-time highs on Tuesday and Wednesday for the S&P. Thursday was kind of a bleh day. And then we had a pretty big down day on Friday, which was options expiration. And now I've been talking about this literally for years now. Valuation. We look at PE ratios, the price to earnings ratio. They've been overextended to the upside for years. Not only when we look at historical earnings to price, but when we look forward and look at forward earnings projections to price. And now all of a sudden, the market seems concerned about it. Now, a few weeks ago, when we hit some difficult times, the market was concerned about then and then about it at that time, and then it got over it, and we went on to the next little up move. But we haven't been trending now for a number of weeks. And even though that can be very frustrating for a lot of folks, there are strategies that I teach in the program that I have where you can make some pretty decent returns without taking an awful lot of risk, even in a sideways market. And if that's of interest to you, go to the link and see if you like what you hear. So, or if you want to set up a time to talk about things, either on Skype or Zoom or Messenger or what have you. But the market is they're concerned about valuation and maybe there's a loss of momentum. I'm just chalking that up. For many weeks now, we've not been trending. And yeah, you could say that a different way and say there's a loss of momentum. And is the market at a near-term top? Perma bears will tell you, 3 months ago, we were at a top and the crash is right around the corner. The perma bulls say, no, we're just getting ready here. Well, we try to take more of a perma realistic approach and say, okay, yeah, we could be. What we're trying to evaluate right now is the weakness that's starting to come in. Is that just a pullback or something more serious starting to develop? And we can only take that on a day-by-day basis. Okay, and then Friday was options expiration. That probably explains some of the craziness. And there's also economic growth concerns. Some data came out on Friday with housing. What was it? Some kind of housing report came out, and consumer sentiment is going down. People aren't feeling really good right now, nor are they looking. With all these changes going on, people aren't really sure what to feel at this point, and they're concerned about inflation. And that was given as the reason for why we declined on Friday. No, the market wanted to go down, and it's just it could use which way the wind is blowing as an excuse to go either up or down. And then disappointing earnings, Walmart, which is a huge part of retail, they didn't have a really good report that was well received, and so they got hit pretty hard. And then the mega cap stocks, they really didn't participate. Growth didn't really participate this past week, and small caps got hammered, where they should be to the moon by now, but they're not even off the launching pad. And then the rest of the S&P 500, the Professor and Marianne part of the S&P 500, the broader part actually held up a little bit better. But it's also more defensive areas that held up, and that's what we're keeping an eye on. And there's all this talk about the tariffs going on, but the market is kind of stepping back and saying, okay, let's not freak out every time there's a headline that says there's going to be another tariff. Let's treat it as Trump is probably treating it, and it's more of a bargaining chip. It's like, I'm going to declare a 25% tariff. Well, that brings people to the table, and then we can talk about things. And so they're seeing it as not something really permanent, just a negotiating tactic. And then there will be an auto tariff rate at about 25%. He's announced that. That's supposed to start April 2nd. And he's also considering other tariffs on pharmaceuticals and semiconductors. He's trying to bring everything back into the U.S. And this is what he thinks is a good way to be able to do that. And then United Healthcare, they're under a Department of Justice investigation, something that really hit the stock hard. And that really took the Dow down, and it kind of took the rest of the market down with it. And we did decline. We're at 4.42%. With the 10-year yield, where a week ago we were at 4.48%. We got back above that 4.5% throughout the week, but then we ended up coming down below it. And the dollar was down for the week as well. And that could have helped at least support stocks for a bit throughout the week. Okay, so the Dow was down 2.5%. Now, there's only 4 trading days this week, but this is from Friday to Friday. So the Dow was down 2.5%, as was the NASDAQ. The S&P was down 1.7%. Small caps, this is the Russell 2000. They just got hammered. They were down 3.7%. Really a lot of frustration with the small caps. Now, I don't do them personally, but a lot of people think, okay, here we are, Santa Claus rally, January effect. Historically and seasonally, they should be going up right now. They're not. They burst up a little bit and then they come back. They burst up again and then they come back. And they're kind of on a treadmill. They're really not going anywhere. This is something that I talk about every week, just in case we're heading into this part of this graph here from 1966 to 1982, where after inflation was really coming down and looking pretty good, it really shot up after that. Now, we don't know what's going to happen. There's people that predict and forecast and all that. We watch data. But we just want to, the main thing that I want to show with this chart is things the way they are right now doesn't mean it's the way they're going to be in the future. And that can be either a positive thing or a negative thing. So we want to just keep an eye on these different economic reports that are coming out. Also, we're under that 4.5%, but we're still above 4.02%. And this is research done by RenMac that says when we get above that 4.02% level, the earnings per share start dropping. And that's what we've been seeing. It's once we got above 4.02%, that's when you started to see the forward-looking earnings starting to come down. Now, they're still positive, and we're still seeing growth, but not as robust as what we were seeing before. This was updated a couple of weeks ago now. It'll be updated at the beginning of March when we get the next employment situation report. And this is a week old. I didn't have this chart this week at Isabel Net, but this was a week ago. But we've been seeing the same basic thing for a couple of years now, where we're up and to the right as far as earnings looking out into the future, whether it's Morgan Stanley or a consensus. And that is still positive. Even though these numbers are coming down, they're still going up looking forward. All right, bull markets last longer than you think. Okay, the average ends up lasting 67 months, and then the median is 60 months. So that's 5 years right there, or 5.5 years, depending on how you want to look at it. And we technically started the bull market that we're in right now in October of 2022. And so there's still more legs to go with this from what we've seen in the past. Okay, and then this is trying to give some hope to small caps here. Are they at the upper end of their 4-year range, and are they going to break out to the upside? About the time everybody gives up on trying to catch small caps, that's when they're going to break to the upside. When nobody wants anything to do with them, they're tired of getting frustrated, and they just kind of give up and walk away. That's when they break to the upside. Okay, and then gold against other assets. Gold has really been going up. It's been outperforming cash. It's been outperforming bonds. It's not really been outperforming stocks. Now, the S&P is under a little bit of pressure right now, and this chart came out before Friday's session. Yeah, it was before Friday. And so stocks have been doing really good, and gold has been doing good. That's why we're not seeing this ratio really going up. It doesn't mean that one's doing worse than the other. It means they're doing about the same. Okay, and then gold, consecutive weekly gains. We're getting kind of high up here, maybe a little too euphoric, perhaps. And then the earnings per share for growth with the large caps. That's what I focus on. That's the gray area where we're seeing. We go back to 2022. These are historical reports that have already come out. This is looking forward. And do we see positive growth? And there's a lot of folks that are really anticipating small caps doing good. So why isn't their index taking off? Well, it just isn't right now. And so we might see revisions for these future numbers actually coming down. But this is pretty healthy. 10% for large caps, that's the S&P. 10% for the full year, 2025, second quarter, I'm sorry. And then the third quarter, 15%. They're always a little more optimistic the further out you go. And then as they get closer, it becomes a little more realistic. Okay, we did get the leading economic index or indicator that came out on Friday. The big takeaway from this is we came down below this red line. That's usually when there's a signal that there's going to be a recession. Well, we didn't go into a recession, and now we're back above the red line. So this is one of the charts that's actually looking more positive that we may not go into a recession. And then this is kind of a variation. Later on, I show the Fed balance sheet. This breaks it down. And what are the different parts of the Fed balance sheet? You might want to pause and look at this. And then Goldman Sachs Prime Services hedge fund leverage. We're still seeing a lot of leverage going into the market. And that means they're borrowing money, or they're using futures contracts that are highly leveraged, or they're using juiced ETFs and those kind of things, which are great when the market's going in the direction you want it to go in, but it kind of creates a crumbling pyramid if things start to turn and go the other way. And S&P 500 wipes out this week's advance. Yeah, we were up on the year now. We were up on the week until Friday. And then FactSet, we're kind of coming out of earnings season now. And it's just saying here that those companies that have international exposure, and these are S&P 500 companies, they have to be based in the US, but they can do business with other countries. They're doing better. They have growth for earnings above 20%. And this just compares whether they do their business in the US, outside the US, or a combination of the two. And we're seeing pretty good growth in that area. We also see that here with the aggregate revenue exposure, 59% in the US, 41% internationally. And then this is the estimated earnings growth actually going forward here. Okay, now looking at the intraday chart, things were holding up okay. We were kind of lazily going through last week on Friday. We kind of bounced around a little bit on Tuesday. Wednesday was really when we saw things looking more positive. And then this was actually kind of encouraging. We gapped lower and came down on Thursday, and then we set up a base, and then we came up off of that going into the close. This is the smart money coming in and doing some buying. Then we had Friday, and we didn't see much of a gap, but then we just kept going down, 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 down here. This is about at the 50-day moving average on the daily charts. And we tried to bounce. We tried to set up a base, but there was no buying to be had. So we ended up closing right about down at the low for the day. So looking at just the 4 trading days for the week, all the indexes were down, led by the small caps. Going back to the beginning of the year, we have mid caps and small caps are now negative on the year with the NYSE. And this is rather encouraging. This is the broad market. It's doing about the best. This is the rest of the S&P 500. With the NASDAQ 100 and S&P, and then the Dow, which had been doing better, and NASDAQ right in here. So, yeah, a lot of folks have been focused on the mid caps and small caps, and they've been really frustrating to this point. So we ended up closing down. We had the tech sector getting hit the most on a percentage basis. Discretionary, these are the 2 big growth areas. We need them to be positive for the market to go up. They just got hammered on the week. And let's see, staples were up, and that's a defensive area. Utilities barely were up, but they held up better. These tend to be more defensive, as does healthcare. Even though it was down a lot less. We also, communication is another growth area that we want to see doing well. It's just not, it didn't come off having a very good week. Then I sort them a different way by how strong is their particular sector. There's 11 sectors in the S&P. Still, even with the weakness that we saw this past week, communication is coming in at 95. It's still looking good longer term. The financial sector is still looking pretty strong, but these are the only 2 areas right now that are in the 90s, where we have utilities and discretionary in the 80s, and then healthcare, which had a good week, but it's longer term. It's not looking all that good. And the material sector is actually the weakest. It's under 10 at 9.3 right now. The higher the score, the better looking on a chart based on non-emotional factors that particular sector is. So this is just the 4 trading days for the week where we saw staples, healthcare, utilities, and real estate. These are areas that have been lagging, and these are more defensive areas, not so much real estate, but especially staples, where discretionary, tech, and communication was up just a little bit here. But the big growth areas just didn't participate this week. Going back to the beginning of the year, we now have discretionary down. Now, if you remember back to last summer when we had the end of the world day and then we bounced up out of that, since that time, the discretionary sector had been the best performing sector until the end of 2024. And now, so far in 2025, it's really under a lot of pressure. And most of the discretionary sector is Tesla And Amazon's holding up okay, but Tesla's been under a lot of pressure. And we have the tech sector now down year to date, and the industrials are virtually changed. Well, we do have some other sectors that are now positive on the year. This is what we're waiting to see. Are these more defensive areas going to come in and start seeing some continued favor? That's going to change the overall climate of the market. Or is this just more of a short-term thing that the market's going through right now? Maybe a little tiff, you break up for a couple of days and then you get back together. That's what we're waiting to see here. Because you can pretty much liken the stock market to a seventh grade relationship. Okay, so we don't really have any strong areas right now. We have XLY, which is discretionary. It was strong, starting to show some weakness. Communication, still green, but showing some weakness. The financial sector showing some weakness. XLK, which is tech, that's not really strong right now. And we're seeing a little bit of an improvement with the energy sector. And these other areas are just still trying to figure out what they want to do. So we still have communication, which is green, but that didn't have a really good week here. And more neutral would be financials and discretionary. These red areas are negative, and we're seeing weakness, but they're still strong with the tech sector, energy, and healthcare. These are two more defensive areas. And then looking at the different indexes, we have the NASDAQ 100, which is still leading things. It's still looking okay, but now it's starting to pull back. The S&P 100, which are the biggest stocks that make up the S&P 500, that was a stronger area. It's now pulling back here. The S&P is still trying to come on strong, but that's the rest of the S&P, not the mega cap 7 stocks that really drive the index. And then the other indexes are really having a difficult time figuring out what they want to do. Okay, so we still have the S&P 100 and NASDAQ 100. They're still positive, but showing some weakness. And then down here at the bottom, we still have the S&P 500 that's hanging in there. All right, as far as sentiment, we were neutral for most of the week. After Friday, we now dropped down. I call this negative, where they use the term fear. And you can see we never were able to get above 50. So we're seeing sentiment turning more pessimistic right now. If we drop all the way down to 25, that's when we get overly pessimistic, and that's when we think of using this as a contrarian indicator. Active asset managers. Now, this was a week ago. They were starting to get a little more positive, maybe a little too positive. They're probably not going to be as positive when the next report comes out. And this also shows that coming in at 91.48, we're above that 90 level. They're getting a little extreme. When they go above 100, that's when they're really extreme positive. And they're human beings just like everybody else, and they tend to chase what's already happened. The VIX did go up, and most of this came on Friday. We were maintaining things around the 14, 15, 16 level for most of the week. Well, we shot up into the 18 range now, but we're still below 20. But it did go up for the week, both here with the closing line chart. That just shows the closing values, and the bar chart also. But we're still under 20. That's the positive takeaway. We're still positive here. When we look at cash versus the tech sector, when this black line's going down, that's still positive. And the poor Ridex bear bull folks, they're just getting whipsawed right now. They were positive. The next reading that we get, we'll probably see a real spike up because they weren't prepared for Friday. And there's a 1-day lag with this chart. The individual investors are back to looking a little more negative, and the 50-period moving average is coming down. And so they've been slowly starting to turn more negative on the market. We're still below the moving average with the Ulster Index, which is another sentiment gauge. We're still looking good here with the spread between risky and not as risky bonds. We're still seeing high readings here, which means there's not a lot of fear in the bond market. So we're not seeing this part of the market really freaking out right now. The VIX and then the 3-month average of the VIX just kind of coming down a little bit here, not really giving us any conclusion. And we're still going down with our long-term 253-period moving average of the equity put call ratio. That's positive. And we're still below this black line with the national financial conditions. We're coming in at about 2.25%, maybe 2.33% with the GDP estimates here, where we have about 2.5% to the upside and about 1.5% or so to the downside. And this is also the GDP now. We're going to get another look at this number in the upcoming week. Now we've seen this number before, so we're going to be getting it again. There's going to be an update here, and it's if the number comes in about the same as what we saw last time, it'll be a non-event. But if there's a huge adjustment one way or the other, it could really have an impact on the market. And then already high bar for beating GDP expectations. This was at the beginning of the year in 2023. They thought we'd be coming in up here over about 3.25%. This is where we came in. And then at the beginning of 2024, they thought we'd be at about 2.5%. We came in a little over 1%. And we're not really sure where we're at right now for 2025. We're at 2.2% currently. All right, this won't get updated until the next employment situation report comes out, nor will this. As far as inflation, we will on Friday, we're going to get core PCE. So you're going to see these numbers be adjusted. As far as the Fed coming in and either cutting rates or leaving them the same, there's a 96% chance when they meet on March 19th, rates are going to be exactly where they're at right now. And that's pretty much what the market has concluded. Then we look out at the May 7th meeting, there's still a 67% chance, almost 68%, that rates will still be the same as where they're at right now at 4.25 to 4.5. And the market's pretty much locking into that idea a little bit more as well. This is the Fed balance sheet, which has been declining here. And this is the year over year balance sheet, just to see how it's changed from one year to the next. And we keep an eye on this. This is the overnight reverse repurchase agreements. I have a hard time saying that. We're not really seeing any crazy action right now. If this really starts to spike up, it can't really go much lower. And that just means there's not a lot of fear within the financial sector right now. That's kind of my takeaway from this. All right, looking at the advanced decline line, we're still positive based on price and volume. We actually went up based on volume. And we've been seeing that on the daily side, where volume has been performing better than price, which can be positive. But tell that to Friday when he's like, okay, yeah, I got into a number of positions thinking that volume was leading price, only to see a 1.7% decline. And then looking at the new highs, new lows, we're still looking pretty good here. We're seeing more new highs than new lows, but we're seeing a contraction of the new highs. And we're still going up with our 4-week moving average, and we're leveling off with the 10-week moving average. We're dropping below zero here with our 19-week advanced decline ratio. That's turning things a bit more negative, and we're just barely going negative with our 39-week advanced decline ratio. We're still not trending. The ADX continues to be below 20, and it's declining, and it's below its moving average, and it just keeps going lower and lower. We're seeing that same thing in the short and intermediate term on the daily side. After Friday, we switched to negative, where the red line's above the green line, but on this chart, the green line, even though it's going down, is still above the red line. So we're still positive longer term. We're still positive here with the Arun. The green are buyers, the red are sellers, the oscillators, the difference between the two. Mass index is not generating a signal right now. So here's a daily chart, and it's kind of hard to read because now we've got the pivot points coming in for February. And once those are set, they'll last for the whole month. And then you can see where we've been above average with volume pretty much most of the days last week. Now, on a trending basis, we're still looking really solid here. This is the S&P 500. It's above the 50-week moving average. All the lines are still going up, even with Friday's decline and the decline that we saw for the week. We're coming back down close to the 13-week moving average. We're also dealing with a 50-day moving average on the daily charts. And we're still looking positive here, but pulling back when we look at smart money indicator number 1. It's above the moving average, and the moving average is going up. So this is still positive. We're starting to turn more negative here with the chicken money flow. This is smart money indicator number 2, where the red line is now coming down. It's still positive since we're green, but we follow what the red line is doing, and that's declining. And we're also declining with our third smart money indicator. So there's some weakness that's coming in here. There's still some positive things too, where the smart money indicators were really holding up well and doing great until Friday. That's when things started to shift over, and a lot of that got picked up here on the weekly chart as well. So we're declining with our third smart money indicator. So the first one is still positive, but showing weakness. 2 and 3 are actually turning negative. The vortex is coming down, but we still see the green line above the red line. So we're still positive here, but seeing some weakness. And then we have the pivot points. We're in between right now. You can see other times when these pivot points, and once these pivot points are set, they last for the whole quarter. So they're good for 3 months. And they can be very influential, but we're right in between both of them right now. This, I've been just hammering this in the daily videos. This is a trend channel. Now, I drew the lines on here, so it's probably far from exact, but I tried to connect the 2009 bottom and then to this bottom, and then I drew a parallel line up here, and I tried to match up with the tops, even though we got above that in 2021. We're right at this point right now, and that could be producing some longer-term overhead resistance. And we're below zero and declining with the McClellan oscillator, so that's turning negative. But we're still positive with the summation index. We're above zero and going up based on price and volume. And we're seeing volume doing a little bit better here. That's more encouraging. And we're above zero based on price and volume with the Swindle trading oscillator. That's encouraging as well. But when we look inside of the S&P at how are the PMOs, the price momentum oscillators actually doing, we're seeing a decline here with the PMOs that are rising, but we're seeing a little bit of an uptick here with the buy signals, but we're leveling off here with the PMOs that are above zero. So not falling apart, but not showing a lot of strength either. And the bullish percent index, it's now going back down. We're seeing pretty much that same thing on the daily side. Here on the weekly side, I don't put a moving average on here. I do on the daily chart. And when we drop below the moving average, even if we're still above 50, we count that as negative. So this is declining now. We're coming down, but still above zero with the price momentum oscillator. And we're still above, we're actually going up a little bit here based on volume. So you can see how volume's kind of leading price a bit here. Now, on a momentum basis, though, we saw some weakness on Friday, but we were actually turning positive on the daily side, where we remain negative pretty much across the board here, short, intermediate, and long-term on the weekly side. We're negative with the Copic curve. We were just about ready to turn positive after Thursday. Well, now it's back to negative on the daily side after Friday. And we're negative here on the weekly chart as well. We're declining here, but we're still above the midpoint with the Bollinger Bands. And we're declining and still slightly positive with the force index. We're below 50, but advancing with the money flow. And since we had a down week, we're below zero with the 1 week rate of change. We're coming down from this red line with the 50-week rate of change. That's a little bit longer term. And we're declining, but not extreme here with the Stochk RSI. We went from being extreme positive to 1 day in the middle to extreme negative all over 3 trading days on the daily side. This is a very touchy indicator. And we look at the RSI, we're declining, but still above 50. So that's positive. The Williams percent R had been giving us good, strong readings here, suggesting long-term momentum. That's falling, but we haven't gone below the midpoint yet. We're falling, but still above 50 with the ultimate oscillator, and we're still above the moving average with our special K. And we're coming down. We're still a little bit above the 10-week moving average. This is longer-term support. This is the first level of longer-term support. If we keep falling, then we'll hit this next 40-week moving average down here. And if we really keep going down, I mean, this means we're in a bear market at this point. This is like a 200-week moving average. That's very, very long-term. But so far, we're holding out above this support level. And we're still positive when we look at the Heiken ASCII chart. We have open candles. We're positive with the Kagi chart. We're positive with the Renko chart. And we're coming down. We've gone negative with the ease of movement on the daily side. We're seeing weakness here, but we're still positive. And we didn't see enough of movement this past week to generate any X's or O's with the point and figure chart. Seeing a drop off here with our long-term momentum, intermediate terms flat to slightly declining, actually seeing some negative action in the short term. Now, this is short-term weekly, so it's kind of long-term and short-term mixed together. All right, we've gone from positive to neutral with the Elder's Impulse system on the weekly chart. We're still positive with the parabolic SAR. We've gone negative now on the daily chart. No, I take that back. We're still positive on the daily side. So that's still positive for right now. We're negative in the short term with all the different indexes. With mid caps and small caps, they're negative in the intermediate term. And so stocks are negative in the short term. Bonds have switched over to positive in the short term. We're positive across the board with commodities, and this might be part of the problem. The commodities are doing well, and the market's perceiving that as inflationary, and we're negative in the short term with the dollar. So we see the S&P, it set two all-time highs this past week. It's looking pretty good, but you can see the divergence here between the mid caps and the small caps. Not really showing a lot of strength with these other indexes. The Dow's falling a little bit below its 13-week moving average. It'd be nice if it could get back above that. And the NASDAQ's coming down a little bit below the 13-week moving average here, where the NASDAQ 100 is still a little bit above the 13-week moving average. So there's still some hope there. And here's a weekly chart with the red candle for the down week after setting an all-time high. So we're not too far from that still. The mid caps, though, you see how they're showing more weakness? We're coming down potentially to the 50-week moving average, and we're at the 50-week moving average with the small caps. That equates to a 200-day moving average, and that's what we're dealing with on the daily charts. That's a pretty significant level. But we came down here before and bounced up off of that. Is something like that going to happen this time? Or if we break through this, that could mean that things are turning more negative. The NYSE still above its 13-week moving average. So even though it declined, it's holding up pretty well right now. The FANG index is coming down to its 13-week moving average. It just set an all-time high recently. And this is a daily chart of the Wilshire 5000, another broad market measure. We actually fell below the 50-day moving average. All stocks pulling back, but still above their 13-week moving average. ARC, it was down over 10%. My gosh. And it's still in an uptrend, but it just got hammered. Most of that came on Friday. The bank index still holding up fairly well here, still above 50 with the RSI, even though we're declining. We're starting to go back negative longer term with the momentum. Seasonality, the second part of February is not all that positive, and I'll show you another chart of that later. And then we're looking at Dow theory, where we're just coming off. We did set an all-time high here, but we didn't get all that far from it. You can see where the transports are negatively diverging, and even though the utilities have been coming on, they're negatively diverging as well from the Dow. So is that going to bring the Dow down, or is the strength in the Dow going to eventually bring the transports and the utilities up? All right, then here's commodities. This is a weekly chart here, and we are in a longer-term uptrend. Oil, it's not really causing a lot of inflation right now. It's getting into the low 70s. The dollar is still in an uptrend, but it is pulling back, and that the pullback could be more positive for stocks. Copper is still in an uptrend here on the weekly chart, even though it was down on the week. Gold is coming off of setting all-time highs, and silver's been doing quite well lately also. And we're coming back up now with the total bond ETF here. That's positive. If we can keep going up with this, if this goes up, that means interest rates are going down. The stock to bond ratio monthly chart did pull back here, but it's still showing longer term stocks are outperforming. This is a daily chart where we see that overall interest rates have been coming down lately. This is a weekly chart, and we're watching the red line here, Japan, to see if this just keeps going up. And is that going to matter at some point? When they came and got above 1% last summer, that's what freaked everything out on the end of the world day. Well, then we pulled back from there, and now we've been going up ever since. Now, the Bank of Japan recently raised rates, and they're trying to keep things under control there. But is this going to cause another chain reaction, a contagion type of a thing, like it did for a couple of days there last summer? Then we're still seeing gold performing the best so far in 2025, with bonds now are in second place. Can you believe that? And then stocks are in third place, oil is in fourth place, and now the dollar is back to being negative on the year. We look at the NASDAQ 100 to S&P. This is still looking pretty strong longer term. The S&P 100 still looking strong when compared to the S&P 500. We're seeing a bit of a pullback now between growth and value, but nothing that we haven't seen before. It's just, are we going to continue to fall with this ratio, or are we going to hit some support and bounce back up here? And then, as I was saying earlier, when you compare gold to the S&P, lately, gold's been outperforming as the S&P has been trendless. But when you look at this longer term, it's like they're both kind of equaling each other as far as performance. Bonds continue to underperform stocks longer term, and gold is also back to outperforming the dollars. The dollar's seeing some weakness and gold's been going up. Low volatility stocks, they are coming back up now. Now we're still in a downtrend. Are we going to be able to change and go back down? That would be more positive. If this continues to go up and we eventually see a golden cross with this ratio, that could be that the market's getting more defensive. And this is what happened in 2022. We saw this ratio going up. Well, we're watching this, but it hasn't switched yet. And it's threatened to switch a couple of times here throughout 2024, only to start going back down. So those are the things that we're watching. And discretionary to staples, pulling back, but discretionary still outperforming longer term. Energy bouncing back up, but still underperforming the tech sector. So yeah, these areas are seeing some weakness, but they haven't switched from one direction to the other. And the small caps, the tech, well, even though tech took a bath this week, small cap stocks took a bigger bath, and this continues to go down. And then longer term, not really seeing anything here with the NYSE Brett Thrust or with the ZWAG NYSE Brett Thrust. We're still at a full-on buy signal with the Zohar-Chak method. That's still positive. We're still well above this trend line going back to 1987 with the S&P. And we're just kind of chopping around right now when we look at the 50-period moving average of the new highs, new lows for the S&P. Also chopping around when we look at the NYSE new highs, new lows. And that's also a 50-period moving average. We're still above this trend line with the NASDAQ 100. We're still above this red line with the NASDAQ to Dow ratio. So things are seeing some weakness, but they're not falling apart, at least yet. And we're actually going up here. The Qs, even though they held up a little bit better, this ratio is going up. That means that they're really outperforming small caps. And then we're keeping an eye on the 3-month yield. It's kind of flattening out as we got into the latter part of 2024 and into 2025. We're leveling out here with the cumulative new highs, new lows for the NASDAQ. And then seasonality, where February, the average return is 0. And it's up 53% of the time, which is slightly better than a coin toss. But then when you look at November to April, this is the strongest part of the year. But we're in the weakest part of February right now, historically. We're also in a weak part. The first quarter after a presidential election tends to be weak. This hasn't been updated now as we've been going through February, but these are just different ways to measure the seasonality going out for the rest of the year. This is the second half of February, which can be weak. And we're up 9, we're down 9, 50-50 there with an average return of 1.3 for the S&P after an election year going back to 1950. So thank you. I really hope you found this helpful. Please feel free to check out some of the other videos that I post. You might find them really helpful to you. Have a great weekend, and I will talk to you in the next video.